Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Well, uncertainty is back. You wouldn't know it judging by risk premia today in the equities and credit markets. But consider this. A well-respected market strategist and a well-respected Fed governor expressed wildly different views of the labor market this week. Nancy Lazar of Piper Sandler said this labor market is the healthiest in decades. Meanwhile, Fed Governor Chris Waller calls the labor market weak and fragile. Or these views on the strength of the economy. CEOs surveyed say, quote, "The economy is materially worse now than it was 6 months ago, and expected economic conditions to weaken further over the next 6 months," unquote. That's according to the latest Conference Board measure of CEO confidence. Meanwhile, the Atlanta Fed GDP Now estimate for Q2 growth is a downright robust 3%. These are just two examples of the differences in opinions rattling around out there. And then we have geopolitical conflicts, dissents among central bankers, and OES trade policy adjustments back on the table. Safe to say, uncertainty is back. This week, our three things are: 1. Hyperscaler debt issuance. Funding the AI build-out goes global. 2. Next wave growth. Beyond AI and wealthy household spending, these forces will help. And 3. Industrial renaissance. How real is it? All right, let's dig a bit deeper. Hyperscaler debt issuance. Much attention has been paid to the rash of hyperscaler debt issuance. We've talked early and often about the financing burden the AI build-out presents. McKinsey keeps increasing its estimate of that, which now sits at over $7 trillion over the next 5 years. The good news is that the AI build-out story can be accommodated by a multitude of financing markets. Equity, high-grade and high-yield corporate bonds, both public and private, bank loans, CMBS, project finance, asset-backed securities. And let's not forget that much of this funding burden will come from hyperscaler free cash flow and borrowing capacity, both being substantial. So let's put some context around this. The advanced economy's non-financial corporate debt market, that's loans and bonds according to the BIS, is $61 trillion. Issuance of $7 trillion spread out over 5 years doesn't seem like all that much. But in the U.S., the total non-financial corporate debt market is $22 trillion, so $7 trillion is more material at 32%. So it should come as no surprise that U.S. hyperscaler issuers would look to overseas markets. Reuters points out in a piece this week that hyperscaler issuance have set records for the largest deals in euro, sterling, yen, Canadian dollar, and Swiss franc markets. Bank of America is quoted as saying that hyperscalers are planning to do 30% of their debt financing this year overseas. The appeal to global investors is threefold. 1, the businesses being financed are familiar to global investors. These are global products with U.S. public issuer disclosure. 2, given the size of issuance, the yields are reasonably attractive for high-quality industrial paper. And 3, it's not another bank bond. On the latter point, the high-quality part of the corporate bond market is dominated by bank issuance, which has dependably lived up to its cyclical, if not super-cyclical, reputation over the decades. Investors are always on the lookout for high-quality industrial bonds that diversify down their portfolio's concentration in bank paper. Expect this sector, both in the U.S. and abroad, to remain open to add. All right, on to our second thing, next wave growth. Tech capex and wealthy household spending. Those are the two engines driving the U.S. economic growth to healthy levels, call it around 2%. A glass-is-half-empty view is that this narrow foundation is suboptimal. Both are vulnerable to the same thing, a recalibration down as to the net impact of AI. Now add in the natural headwind for growth that comes in the form of higher inflation and inflation expectations, along with possible increases in the effective tariff rate, and that glass-is-half-empty view is starting to look more like a base case. The good news is that there are growth engines offsetting these concerns. The first is the benefit of 175 basis points of rate cuts in 2024 and 2025. While future rate cuts are very much up in the air, the most recent cuts are now flowing into the economy following their usual lag. The second is that the tax cuts and incentives coming out of the One Big Beautiful Bill. Brookings believes the act will add meaningfully to GDP to the tune of 36 to 63 basis points of GDP a quarter through mid-year 2027. A third growth engine comes in the form of deregulation. Less onerous bank capital regulation, incentives to promote home ownership and building, and less restrictive energy regulation are among the sectors that should be helpful here. Now add all of this up, and you get reasonable growth through 2027, making that half-empty glass half full. All right, on to our third thing, industrial renaissance. While the U.S. has long since shifted to a services-based economy, manufacturing still matters well beyond the 10% of economic output it accounts for and the 9% of the labor force due to its high multiplier effects. The sector had been hit hard by the rise in rates in 2022 and 2023, as it is among the most interest rate sensitive industry groups. But recent manufacturing data is showing real signs of life. The benefit of the recent 175 basis points in rate cuts has helped, as has a pickup in demand driven by reshoring initiatives, tech capex, and the need to build up aerospace and defense. On the data front, industrial production has bounced steadily higher from 2024, when monthly year-over-year growth rates were negative in 11 of 12 months. The most recent print in April, plus 1.4%, was the eighth of the past 10 months above 1%. This follows another strong data print from the S&P Global U.S. Manufacturing PMI, where its May result came in at 55 in its diffusion index. Remember, that's where readings above 50 suggest expansion. That was the highest in 4 years. And finally, we got the Fed's Beige Book, where manufacturing activity, quote, increased at a modest to strong pace for 9 of the Fed districts, and only one noted a slight decline, unquote. A modest to strong pace. Well, that's a market change from a year ago when most firms reported flat sales and sentiment became more pessimistic due to, quote, elevated levels of economic and policy uncertainty, unquote. Markets confirm the rebound. S&P 500 industrials have outperformed the equal-weighted index in 2026 by 240 basis points. So there you have it. 3 things in credit. 1. Hyperscaler debt issuance. There are plenty of constraints: power, environmental, water, technology, but capital, for now, is not one of them. And 2. Next wave growth. It's driven by more than just tech capex and wealthy household spending. And 3. Industrial renaissance. It's happening, but keep its impact in perspective. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.